Welcome to the Savvy Commercial Real Estate Podcast, your resource for relevant, helpful, and immediately usable information regarding all things commercial real estate. Whether you are buying, selling, financing, exchanging, managing, or developing commercial real estate, rest assured you are in the right place. Savvy Commercial. Listen, apply, repeat.
Good morning, everyone, and welcome to the Savvy Commercial Real Estate Podcast. Joining me today is my guest, Noah Brocious, the president of Capital Fund One, based in Scottsdale, Arizona. Mr. Brocious is a principal and the president of Capital Fund One, as well as an investor in Capital Fund Two. He is also a licensed mortgage loan originator and a responsible individual, or RI, for the company. Noah is an Arizona native and graduated from Scottsdale Christian Academy in 1999. He then attended California Lutheran University in Thousand Oaks, California, where he played 4 years of men's basketball, and graduated in 2003 with a bachelor's degree in business administration with an emphasis in finance and a minor in Spanish. Noah, welcome to the Savvy Commercial Real Estate Podcast, and thank you for being here today.
Yeah, thanks, Neil. Really appreciate you having me on today.
Well, we appreciate you coming. Look, before we jump right into it, why don't you just tell us a little bit more about your background, if you don't mind, including, how'd you get in the real estate business after graduating, and why'd you choose real estate or lending in the first place?
Yeah, absolutely. So like you mentioned, Arizona native. I graduated from Scottsdale Christian, then went to California Lutheran, where I played basketball. Didn't really know exactly what I wanted to get into, so I ended up doing an on-campus interview with an insurance company. Took a job with that company and failed miserably at trying to sell insurance. I quickly realized I was not good at talking to people about the last thing in the world they wanted to talk about. So did that for about a year and a half, and then got into real estate. So my roommate at the time was working with his dad, Mike Anderson, who had basically spent his whole career in real estate. He had done some land banking, land development. So this was back in 2004 when the land market was pretty hot. So we did some smaller land development deals. So did that from 2004 to 2007. Then I got the opportunity to work for a commercial developer here in town, Panettone Development. They're based out of Sacramento, but they had opened an office out here. So I was a development manager at Panettone for a couple of years. We developed 4 industrial projects throughout the valley, so that was good. Got to learn a lot more about the development world and commercial real estate. But obviously, as we all know, in 2009, things kind of came to a screeching halt. They shut down the office. So I was out looking and hooked back up with Mike and Justin. So they had started poking around at the trustee sale auction, buying single family residential properties and doing fix and flips. So they needed some help with that. So I came and joined them. And then while we were down there, we met some investors that needed some capital for some deals. So we ended up making a few loans and just realized what a demand there was for capital back then. A lot of properties purchased, not much money out there. So we decided to pivot, focus on the lending side of the business. And that's when we started Capital Fund.
That is a great story. I had no idea about any of that. Some of the names sound familiar, from Mike Anderson to Panettone, but I would have never been able to piece that together. I think, it's just great to find out how some of these relationships come together. If this was a sports podcast, which it's not, now I'd be asking you about the Spurs' recent number 1 pick. But I'm sure you've got some comments on that draft, but we'll save that for another day.
Sounds good.
So instead, Noah, today we're going to be talking about commercial real estate financing, of course, and more specifically, private lending. Can you tell our listeners the major differences between what I would refer to as traditional bank lending and private lending?
Yeah, absolutely. I mean, I think the biggest difference with private lending is just the flexibility that lenders in our space have. A lot of times it feels like if you go to a bank, they're trying to find every reason under the sun why not to do a loan, versus the private money world where most of us are trying to figure out how to get a deal done. So there's more flexibility. I mean, the other major difference is that most lenders in our space are what you consider an asset based lender. So they're more focused on underwriting the asset or the project versus underwriting the borrower. As our space has evolved over the past 15 years or so, that a lot of the quote unquote private lenders feel much more like a bank, but a lot of companies like Capital Fund One are still more asset focused versus borrower focused.
So I know from a lot of experience with quote unquote traditional banks, life companies, et cetera, credit unions, they have a certain box, right? And the loan and the borrower have to fit neatly into that box. You said flexibility. What was kind of going through my mind at the time was the word creativity. Would you say that Capital Fund One needs to be a little bit more creative than your typical quote unquote traditional lender, as I said? Because
Yeah.
you're finding, like you said, good explanation. You're finding ways to make the deal versus finding ways to reject the deal.
Yep. Yeah. No, absolutely. I mean, we've definitely done some creative deals over the world or over the years, but yeah, I mean, we have a general box, but it's not as stringent as a bank or a traditional lender. So yeah, we can definitely get more creative to try to make the deal.
Well, just because I'm sure people out there who are going to be listening to this is going to be going through their mind. It went through my mind getting prepared for this. Is private capital, private money, private lending, is that the same as hard money lending, or is there some difference between that?
Yeah, it's really the same. I mean, I think people have moved away somewhat from the term hard money lending, because a lot of people think of loan sharks when you hear hard money lending. But really, what hard money lending actually means is again the focus on the hard asset. So it doesn't necessarily have anything to do with pricing or things like that. It's really that the lender's focused on the hard asset.
So when you see these things, I don't see them as much, but I used to see things like, the softer hard money. I always got a
Right.
kick out of that. Um,
Yeah.
anyway, let's move on to, let's just say, to an actual investor. You gave us some great background. Now let's talk about an actual investor. When an investor slash borrower, I guess, comes to you for a loan, and assuming for the moment, for this particular instance, that same investor could go to a bank if they wanted to. Let's just say they are capable, they would be deemed by a traditional lender to be a quote unquote good borrower, right? So they could go to a bank, but they come to you. So explain to us under what circumstances or in what situations maybe would somebody who could go to either come to Capital Fund One?
Yeah, so there's really two reasons that somebody that is bankable would come
Bankable,
to
that's the
us.
word I was thinking of. Thank you.
Yeah, yeah. So the first reason is really timing. Typically a bank or a traditional source is going to take 30, 60, 90, however many days to close a deal. But we're typically able to close deals in 3 to 5 days. So on average, the loans that we close in about 3 to 5 days. And, we can even move more quickly than that. So when we first started, all we were doing was funding loans on properties that people purchased at the trustee sale auction. So for the people that don't know how that works, in Arizona, if you go down to the trustee sale, bid on a property and win the bid, you have to put down a $10,000 non-refundable deposit, and then you have until 5 p.m. the following day to pay the full balance. So when we started, that's all we did. So we cut our teeth on that 24-hour funding. So that's really the first reason. So a lot of times, borrowers will come to us because maybe they had a loan that they thought they had secured, but things changed, or the lender pulled the rug out from underneath them, and maybe they've got a large non-refundable earnest deposit up that they're at risk of losing if they don't close. So a lot of times we get borrowers that come to us that are working under tight time frames. So that's the first reason. And the second reason, is a lot of times, especially if it's a smaller shop or a smaller developer that doesn't have staff that deals with the lenders and all the back and forth and documents and things like that. A lot of times they come to us just because they don't want to deal with the red tape or the brain damage. They just want to get a deal done, get it closed quickly, and move on with their lives. So yeah, really it's either timing or they just don't want to deal with the brain damage of a bank or a traditional lender.
When you were talking about the trustee sales and the $10,000, I can still remember when it was only $1,000, and obviously that was problematic because we would go to a trustee sale with full intent to buy the property, and you'd get sometimes as many as 2 or 3 guys down there, or gals, all putting up a check. Nobody knew this, but they'd each put up $1,000. Let's say there were 3 of them. So they just bought themselves, let's call it a 3-day option for $3,000. The first one doesn't perform, they notify the second one. The second one doesn't perform, they notify the third one. And in some cases, it takes a day to notify the second and third one. So they turn 24 hours or 5 p.m. the next business day into sometimes a whole week or 4 or 5 days. Now for $1,000 each. So when they raise that requirement to $10,000, well, you're not going to see people risking $10,000, $20,000, $30,000 if they really don't fully intend. Just to get an option, it becomes an expensive option. And what I've noticed, I don't know about what you've noticed, but what I've noticed is that the number of people, let's just call it, tying these things up, to try to flip it and for a quick profit has dropped a little bit because it's expensive now. It's 10 times as expensive, in fact, to do that. And I think it's a good thing personally because it got rid of, I hate to say the riffraff, but it got rid of a lot of that BS that was in that space. And now if somebody puts up 10 grand, I think they're pretty intent on closing the deal, assuming they can get the rest of the money. So when you said that, I had a flashback to to the courthouse steps and attorneys' offices and all these people. They'd carry $1,000 checks in their wallet just for these situations. Anyway, enough of that. Noah, do you specialize in certain asset classes? I know you were talking about the courthouse steps, trustee sales, and so on, but not all your borrowers are buying these things at foreclosures, and up until recently, that there weren't a lot of good foreclosures. So, and you've continued to make loans. So I know you're making loans on non-trustee sale deals. So for those and for any others, are there certain asset classes that you prefer? Will you look at all types of commercial real estate? What's your I don't want to say your box because you guys you said you don't really have a box, but what's your preference if there is such a thing?
Yeah, so we'll really consider any type of real estate as collateral for a loan as long as it's not owner-occupied residential. So when you get into owner-occupied residential, that's considered a consumer loan. and it's subject to the changes that occurred with the Dodd-Frank Act. TILA, RESPA haven't approved the ability to repay. So that's really the only type of real estate that we won't consider. So we still do a lot of single family residential fix and flip loans, but we like all the other asset types as well. So we'll lend on multifamily properties, we'll lend on other commercial assets, industrial, retail, mini storage, hospitality. We'll consider office. Obviously, office isn't the most desirable asset type these days, but we'll still consider lending on office. Then we also do ground up construction loans, either for residential or commercial projects. And then we'll also lend on land. So typically when we lend on land, it's going to be a zoned, entitled, infilled parcel. So we really don't consider things on the outskirts or land loans that have entitlement risk. But yeah, so really we'll consider any type of real estate as collateral.
So when you talk about owner occupied residential, and by the way, I'm also going to assume that you want to be in first position. You're not going to loan on anything, owner occupied or otherwise, if you're in second position, right? We're still talking about a first position loan here.
Yeah, I mean, we'll consider second position loans. Maybe if there's a ton of equity in a deal and the cumulative loan to value between the first and our second is less than 50%, or a lot of times we'll lend in second position if it's cross collateralized with a first position loan.
Got it.
But yeah, primarily first position lending.
Well, okay. Well, getting back to owner occupied just for a moment, not residential but commercial. If the borrower slash owner is the tenant or primary tenant, I'm thinking of a single tenant deal or maybe a multi-tenant deal, but where the owner has the majority of the space. Not necessarily an SBA type loan where you have to have 51% or anything, but I'm talking about single tenant, owner occupied, or small not too many tenants, owner occupied. That counts, right? That's not residential. You would loan on something like that.
Yep, absolutely.
Okay. Let's talk about loan amounts, if you don't mind. There's a pretty big difference, I think, between single family fix and flips and, a multi-million-dollar apartment building or shopping center, industrial building. I'm not even going to mention office buildings. Do you have minimum and maximum loan amounts? And if so, what are those?
Yeah, so we've got a pretty wide range. So minimum loan amounts 50,000, and we don't have a hard cap on the maximum, but that's going to be in the plus or minus $30 million range.
Okay. And then what about things like loan to value ratios or loan to cost ratios? So you establish your minimums, but you're not going to just, turn over the money. And I know that your box is maybe less restrictive than a traditional lender, but you're still going to do some underwriting. So within those underwriting specs or criteria, what have you, is loan to value in there or loan to cost in there? And if so, what is that?
Yeah, absolutely. So yeah, we look at each asset type differently. We'll be a little bit more aggressive as far as loan to cost and loan to value goes on single family residential, just because it's a more liquid asset. There's a larger buyer pool for that type of property. So on single family residential, we'll end up to 85% loan to cost, as long as that doesn't exceed 75% of the improved or after repair value. And then on commercial assets, we'll lend up to 80% loan to cost, as long as that doesn't exceed 65% of the completed or after repair value.
Okay, got it. Just taking some notes. So again, that's minimum, maximum loan amounts. We've talked about LTV and LTC, I guess. How about interest rates and points? Can you elaborate on those two items just a
Yeah.
little bit?
So right now our interest rates are going to be in the 11 to 12% range. So as most lenders have, we've increased our rates as the Fed's increased rates. So right now we're in the 11 to 12% range, and then depending on the loan type and the term of the loan, on the origination fee side, we're going to charge anywhere between 1 and 3 points.
Okay. So going back to that borrower that calls, and they could potentially go to a bank or a traditional lender, or they can come to you. We've heard the advantages of coming to you, but I'm thinking now that one advantage could be that when you really break this down, the perceived savings, if you will, if that's the right word, on the interest rate could be offset a little bit, not just on timing and things like that, because, timing could affect the deal, whether you get the deal or not. But besides just timing and the perceived differential, if you will, on the rates, I'm thinking that a traditional loan is more expensive, and that has to be factored in too, because you might be at 11 to 12. A conventional lender could be at, I don't know, let me just say 7-ish, 7.5, whatever. So there's a gap there, but some of that gap, if I'm not mistaken, can be eroded by the fact that a lender's going to require a whole bunch of third-party reports, and those have to be factored in, right? I've seen $30,000-$40,000, $20,000-$40,000 anyway of third-party reports on a quote-unquote traditional loan. So I'm going to throw this back to you. Isn't that maybe another advantage to dealing with somebody like Capital Fund One? I mean, I haven't gotten really to that in my questions, but can't they really save not just on time but on some costs to do business with Capital Fund One?
Yeah, absolutely. And I think, there's a couple ways to look at it. I mean, like I've told a lot of people, if you put any value on your time, if you consider, maybe it's going to take 5 to 10 hours of your time to get a loan approved with us versus 50 to 100 hours to get a loan approved with a bank or a traditional lender. There's definitely savings there. And the other way to look at it is, especially if it's an investor or developer that's raising equity for a deal, especially in today's environment, the banks and traditional lenders have gotten much more conservative from a loan to cost standpoint. So I was actually talking to a buddy the other day who's an apartment developer, and he said he was running the numbers, and if he can go to a bank and get 50% loan to cost and have to raise the other 50% in equity versus coming to us maybe getting 75% loan to cost, the blended cost of capital can be actually less with us because equity is always more expensive and you don't have to raise as much of it. So that's another way to look at it too, where it makes our money less expensive.
That's actually a great point that I didn't give a lot of thought to, and I'm guessing some of our listeners didn't give a lot of thought to. But what comes to mind, Noah, when I'm thinking of this whole thing is the opportunity costs. If you have to go through a conventional lender and it takes, I'm going to make up a number, 60 days of underwriting and third-party reports, maybe 90 days, before you even know if you're going to get the loan, the deal could be gone. So the opportunity cost, we haven't even talked about that. What's that worth? That could be worth way more than the differential. It could be worth multiples of the differential. It could be worth $1 million. I mean, who knows? It could be worth more than that. So the how do I say this? The certainty of execution is going to become really, really critical, especially in this market, I think, where, I don't think, well, actually, if you back up to the market that we have been in, where people were tripping over themselves to buy the properties, putting up, 100,000 non-refundable day one, the sellers had total control there. You could lose the deal if you took too long. But even in this market, where there might be some real interesting opportunities coming along, if you can't act with some certainty, the seller may give the deal to somebody else who can, especially somebody who can just write a check, and that deal's gone. So I think knowing that you have having an answer quickly and knowing you
Yep.
can move forward with the deal and tell the seller that you're moving forward with the deal, is worth its weight in gold in some situations.
Yeah, and I'd say another way to look at it too is, we've somewhat tongue in cheek told people before that, our money can be free. And what we mean by that is because we can move so quickly, a lot of times our borrowers can go negotiate a much better price on a property.
Sure.
So if they go to somebody and maybe just for round numbers, the seller wants $1 million for a property, and our borrower goes to them and says, "Hey, I'll pay you 850, but I'll close in 5 days." A lot of times, a seller, if they're in a situation where they really need to sell the property, they'll accept a much lower offer if they know that it's going to close quickly. So then you factor in our cost, interest, and origination fees. A lot of times it's going to be less than that $150,000 that you saved when you bought the property.
My gosh, that kind of a transaction pays for this several times over. So that, again, another thing I didn't think about. So Noah, qualified borrower, okay, they need the money. You made a determination in one phone call. The deal is in your wheelhouse. Their loan request falls within your guidelines, minimum, maximum loan amounts, etc. Can you share with our listeners some of the other boxes that you'll need to check off before you commit to move forward with the loan?
Yeah, absolutely. So let's just focus on maybe a Class C value add multifamily deal. So if a borrower's buying a property, we have that phone call. It sounds like it's in our wheelhouse. We'll typically need a copy of the purchase contract, some current photos of the property. We'll need to look at rent rolls, the pro forma they put together. If they're going to add value, we're going to need to see a construction budget. And then the other thing we look at is past experience. So we won't necessarily not lend to somebody that doesn't have experience in the space, but we get more comfort in a loan like that. So we'll ask them for a resume or a list of past projects. So that's really all we need to underwrite a deal. So once we receive all that information from the borrower, we can typically get them a term sheet in 24 to 48 hours, and then close in as quickly as a day or two after that.
So I'm taking some notes here. So term sheet within, you said 48 hours and close within a couple of days.
Yep.
But I heard pro forma. But what about actuals? I mean, I didn't hear that. Is that included with rent rolls in the pro forma?
Yeah. Just to get an idea of what what the current rents are. Typically we ask for a P&L, from the borrower who typically is able to get that from the current owner.
So you're an asset-based lender. I really haven't heard throughout this entire conversation much about, I don't know, credit reports, FICO scores, what do they call personal
PFS.
PFS, personal financial statements, and so on. So it sounds to me like you're going to look, I'm not going to say exclusively, but mostly at the collateral and much less at the. I mean, you did mention experience and the resume and so on of the borrower, but assuming that checks the right box, how deep are you going on the borrower versus how deep you go on the collateral?
Yeah, so we don't require credit checks. It's just not important to us. Again, we're focused on the asset. We don't require tax returns, and we also don't require third-party appraisals. We've got a in-house underwriting team that evaluates and values all the assets that we look at. There's times where maybe depending on the loan, if it's a deal where maybe there's some negative cash flow, we may require some bank statements just to show proof of funds to be able to service the debt. But yeah, that's really all we need. So no credit checks, no third party appraisals, and no tax returns.
All right. Well, so now let's get into the application. I got that, everything you said so far, but let's get into the actual application process. Everybody has an application process regardless of who the lender is. So let's talk about yours versus more conventional or traditional lending. Just if you could, very quickly for our listeners, just describe the application process. How does it differ from maybe the application process with a traditional lender? And I think you talked about the timing. That was going to be one of my questions, start to finish. You kind of covered that. So just how about the application process?
Yeah, we have a pretty simple one-page application. We just need to get a little bit of personal information on the borrower, because we run background checks on borrowers too, just to be able to do that, and then really just information on the project. So it's a much simpler application process.
Okay, good. Listen, if you don't mind, I'd like to just take a minute for those who joined us late or didn't catch my initial introduction and so on. If you could just tell everyone, your name, your contact information for those who might want to get in touch with you afterwards, including maybe a website for them to look at, et cetera.
Yeah, absolutely. So I'm Noah Brocious. Best way to get a hold of me is typically email. My email address is noah@capitalfund1.com. Best number to reach me at is 480-284-4728. And our website is www.capitalfund1.com.
I just wrote all that down. Can you repeat the phone number one more time?
Absolutely. It's 480-284-4728.
4728. Got it. If anybody reaches out to me for that, I'll have it. Okay.
Perfect.
So moving on, I think we've covered a lot of ground here, but just a few more questions if you don't mind. We talked a little bit about third-party reports, appraisals, surveys, PCAs, for those out there, property condition assessments or whatever you guys call those, title reports, and so on. So I know you've covered some of this already, but what is absolutely, positively, 100% always required, and what will you perhaps be maybe a little bit looser or a little less strict about in terms of having it in the file before making the loan commitment?
Yeah, so really the things that are absolutely required are going to be that list that I mentioned earlier. So purchase contract, pro forma, P&L, resume on the borrower. Some things just kind of depending on the deal. If it's an undeveloped piece of dirt or maybe an industrial building, from time to time, typically we're going to require a phase one. And it doesn't necessarily have to be a current phase one. So phase one sometimes is required. If it's a land deal, and the property's been platted, we'll need a copy of the plat. We will typically need a survey, especially on a land deal. But yeah, those are really the things that we're going to need from time to time. And again, we can be flexible on those things if there's not enough time to get certain things. So again, we're trying to figure out how to get the deal done.
So in terms of So the part of the question was, what might you kind of, I don't want to say look the other way on, but maybe be a little less strict about. One of the things I remember from an earlier question was, you don't need third-party appraisals because you're doing that in-house. Property condition assessments, I'm going to assume you're doing that in-house too, or you're going to send somebody out there if you need to. I didn't hear title reports. Do you need a title report?
Yeah, we do. Because we do require title insurance on every loan that we close. So yes, a title report will be required as well.
Okay. So I'm just, again, quick note, you do require title insurance. Okay. All right. So other costs, I know we covered some of this. Let's just pull a hypothetical. I'm just going to pick a number, $900,000. Borrower needs $900,000. What costs can they expect to have to pay, or should they expect to have to pay from the day they call you till the day the deal closes? And the loan amount for this example is $900,000.
Yeah. So one thing that we're focused on is the fact that most people don't like to get nickeled and dimed. I hate it personally, and most people do too. So really, we don't have an application fee and an underwriting fee. There may be times if the loan's a little bit more complicated and we have to get counsel involved, where we may charge a doc fee. You know, maybe in the plus or minus $5,000 range. But really, all we're charging is that origination fee. And if it's a larger loan amount, so call it $2 million or higher, a lot of times we will require a good faith deposit, just to make sure that the borrower's committed. But if we do require a good faith deposit, it's typically applicable to the origination fee.
Okay, got it. Perfect. Let's talk about loan terms. I don't think we've covered that. Traditional lenders, I'm sure, are going to be longer on the loan terms.
Yep.
But what are your loan terms? And if necessary, and let's just say for the sake of this discussion, a borrower can't take you out in time with more permanent financing or a sale, can those loan terms be extended? And how does that work?
Yeah, absolutely. So we'll write anywhere between a 6 and a 24-month term. All of our loans are going to include extension provisions. So typically it's going to include a 6 to a 12-month extension provision. We'll typically charge, plus or minus a point for that extension if the borrower needs more time. And typically we don't have any prepayment penalty. Maybe if it's a larger loan, call it $5 million plus, we might have a short interest guarantee or prepayment penalty of, call it, plus or minus 3 months. But typically our loans don't include prepayment penalties. We don't want to have somebody pay to pay us off quickly. We don't mind short-term loans. So typically we won't have that prepayment penalty.
Okay, great, understood. And I don't know if you track such a thing, but do you track the percentage of your total loan or transaction volume, and how much of that loan volume might be for existing properties versus ground up construction or development properties? Is that something you guys
Yeah,
track?
yeah, we do. So right now, about 70% of our portfolio is single family residential. And then we've got about 7% in multifamily properties. We've got about 8% in other commercial assets. Then we've got about 8% in ground up construction, and about 7% of the portfolio is in land. And just to give you an idea, right now, our portfolio sits at a little bit over 700 million, and we've got a little bit over 1,700 loans in that portfolio.
Wow. 700 million, 1,700 loans.
Yep.
I'd hate to be someone who's on the what would you say, the administrative side of that. I mean, You guys, by the way, that brings up a good point. Do you do your own in-house servicing?
We do. Yep.
Okay.
Yeah, we're you know, little bit of control freaks, and I don't know if anybody's ever dealt with a third party servicer. You know how bad they can be. So we just get more comfort in doing that in house.
Yeah, which is actually one of the reasons I asked you that question. Um,
Yeah.
so what about repeat business? I mean, you've been doing this for a while. Are you getting a lot of repeat customers, or are you getting a lot of first-time customers, or a little of each?
Yeah, so it's more heavily weighted to repeat borrowers. So on a monthly basis, about 65% of the loans that we make are to repeat borrowers.
Got it. Got it. Okay. Which is good because that
Yeah,
means they're satisfied and they're coming back. That's great.
absolutely.
All right. So we're getting towards the end of our time here together, but if you don't mind, I have just a few more questions for you.
Yeah.
So going back to the introduction, so to speak, I said you're based in Scottsdale, Arizona. So let's talk about two things. One is, will you make loans outside of the state of Arizona, number one? And number two, are you located in other markets, or do you have any plans to open in any other markets in the future?
Yep. Yeah, absolutely. So right now we're lending in Arizona, Colorado, Texas, and Tennessee. So we just recently opened an office in Nashville, and we do have offices in all of those states. So we have our main office here in Scottsdale. We have an office in Denver, an office in Dallas, and like I mentioned, we have an office in Nashville. And then as far as future markets, the markets that are on our radar to open up next are going to be North Carolina and Georgia.
North Carolina and Georgia. Okay, so let me kind of throw a curveball in here, not intentionally, but I'm just going to make this up. You get a call from, really making this up now, a
Yeah.
borrower in Florida. I just pulled that out of the 50 states. Borrower in Florida, great deal, fits all checks all the boxes that you might have. Borrower's solid, but the property's in Florida. You didn't mention Florida, but you mentioned states, like nearby. I don't know. Let's see, Nashville maybe, North
Yep.
Carolina, Georgia. Sorry,
Yep. There you go.
Georgia's real close. So let's say you've opened an office in Georgia, but somebody calls you from Florida or South Carolina, which is in between Georgia and North Carolina, or I don't want to say Virginia. I don't want to take you up too far north, but Oklahoma City. None of those really, you don't have an office in any of those cities. What about making a loan if everything else checks the right boxes?
Yeah. So because we're an asset-based lender, we have to understand the market and be able to accurately value the property. And if we aren't open in a particular market outside of those markets that I mentioned that we're in, we just will not lend, because from an operational standpoint, if we were to try to figure that deal out, it would take much longer than usual because we'd have to find local experts to try to get a better idea. So yeah, really the short answer is no.
Okay.
We won't lend in those markets outside of the markets that we're in.
Okay. All right. That's fine. I mean, gosh, you're open in a lot of markets now, and you're opening in some other really good markets. North Carolina
Yeah.
and Georgia are pretty hot right now, and I'm not talking about the weather. Um,
Yeah.
So look, I'm going to put you on the spot real quick, but I do this to everybody, so I'm not picking on you.
Yeah.
I want you to pull out your crystal ball that none of us have, and because you've got a lot of experience in multiple markets. You obviously are on top of what's going on around the country. We talked about office buildings earlier, and everybody knows what's going on with most of the office. Not picking on them, but everybody knows. So pull out your crystal ball and tell our listeners what you think is going to happen in the market over the next 1, 2, 3 years. Mostly commercial. If you want to include single family in there, you can, but mostly commercial. And kind of a B part to that question would be, are there any specific asset classes that you personally feel will either do really, really well or possibly the opposite, really, really poorly during that same time frame?
Yeah. So I'd say my crystal ball is pretty foggy, like everybody else's, but you know, generally, I think over the next 1 to 3 years, I think the market's going to feel pretty similar to how it feels today. I think interest rates generally are gonna stay higher. Um, I think that there's still going to be some uncertainty in the market. So a lot of folks that have dry powder, are going to stay pretty opportunistic. Um, but generally, I think we're just kind of going to bounce along for the next 1 to 3 years. But a big part of that really just comes down to interest rates. If we actually do go into a recession, historically every time we have, interest rates have come down. So I think that would cause interest rates to come down. Um, but I just think it's really going to feel pretty similar. I mean, obviously, office is going to be challenging. That's the asset type we're the most bearish on, and then single family residential. I think really just from a supply and demand standpoint, that's really the asset type that we're most bullish on. Just because there's not much supply out there right now. The builders still have labor and supply chain issues. Municipalities have become more difficult to deal with. You look at Arizona with the new water management program that's going to create some challenges for new residential development. And who in their right mind is going to sell a house if they have a 3% interest rate, and have to trade into a interest rate in the high sixes. So I really don't see supply increasing much at all on the single family side, and I think we'll continue to see steady demand. So that's kind of the asset type that I'm most bullish on.
And then with the steady demand in single family, a lot of people not wanting to sell if they've got, like you said, 3% rates, who would sell today, right, to replace it with 7% or whatever,
Right.
6, 7%. But does that also bode well for multifamily as you see it?
Yeah, I think it does. Just because, obviously we saw a pretty significant run up in values. We did see some depreciation, but that was really, and here and mostly the other markets, we saw 10 to 15% of depreciation. But I think that was really just the fluff coming out of the market. I mean, there was so many people that got in bidding wars, waived appraisal contingencies. So there was a lot of folks that were paying probably 10 to 15% more than the property was actually worth. So between values increasing and rates being where they are, that causes some affordability issues. So I do think that bodes well for multifamily, because people need a place to live. So if they can't afford a house, can't afford to buy a house, they're going to need to rent, and that'll bode well for multifamily.
Sure, absolutely. I agree with you. Well, Noah, it's been phenomenal having you on with us today. I really appreciate it. We've kind of come to the end of our time together. But I want to thank you for not only sharing information about you and your company, but frankly also private capital's role in the real estate industry today. I mean, a lot of people may not understand it as much or think it through as much, but frankly, where would we be without private capital, especially with the quote unquote traditional lenders? I keep saying quote unquote, but the more traditional lenders in many cases are gone or have pulled back or are passing on more deals than ever. Where would we be if we didn't have private capital come in and fill that void. So I think you guys have some, what would they say, smooth sailing ahead for maybe the next few years.
Yeah, there's definitely a lot more opportunity out there these days, and we're going to try to take advantage of that and help investors and developers execute on projects when the banks and the traditional lenders are more conservative or completely on the sidelines.
Absolutely, and hopefully you'll keep us posted when people reach out to you, because once we drop this episode, several thousand people will listen to it. Hopefully, listen to it, and I hope you get some calls out of it. Who knows?
Yeah,
but if you've been listening today, once again, I want to say my guest has been Noah Brocious, president of Capital Fund One, based in Scottsdale, Arizona. If you'd like to get in touch with Noah, you can reach him at either 480-284-4728. You can send him an email at Noah, that's Noah, at Capital Fund One, that's with the number one, capitalfund1.com. And you can check out their website at www.capitalfund1, again, the number one.com. Anyway, thanks to you, Noah. Thanks to all our listeners for joining us today, and we'll catch you all next time. Noah, I hope you'll come back again sometime and give us some more updates on what's happening on the private side of the capital markets.
Absolutely, anytime. Yeah, I really appreciate it, Neil.
Thank you. Have a good day.
All right, you too.
Everyone.